Good afternoon, everyone, and thank you for joining in this webinar session co-hosted by Crystal and AVM Capital. We're delighted to have with us on this webinar Ashvin Murthy from AVM Capital, who will walk us through a macro global market update, and we'll open this up to a Q&A session post that. So just moving into the next slide, obviously just a disclaimer and something that we need to run through for our participants. So for your reference, all the information discussion in this webinar is only for general reference. Making available this webinar, any marketing materials or any market or product information to you shall not by itself constitute a solicitation of sale or recommendation of any product. If you wish to receive a solicitation or recommendations from us, please contact us where relevant, go through a suitable assessment before transacting. The contents of this webinar have not been reviewed by any regulatory authority in Hong Kong and Singapore. You are advised to exercise caution before investing in this product. You should not invest in this product based on the information from this webinar alone. And if you are in any doubt, you should obtain an independent professional advice. Investment in the proposed fund should not be construed as tax or legal advisory. And lastly, this webinar is for accredited investors only. So if you aren't, then you may drop off at this point. Okay, so in terms of the webinar outline, we're going to kick it off with a broad global market outlook update from the speaker, Ashvin Murthy, followed by an overview and a performance highlight update on their flagship fund for AVM. Once that's complete, then we'll open it up into a Q&A session, and please feel free to sort of post questions even during the webinar itself, and then we can take it up post the session. I'd like to next just cover a little bit more because I know we've got a few new folks that perhaps are not familiar with Crystal, so a little bit of us and what we do. So Crystal is a digital private wealth platform. We were founded in 2016. We are located across 4 countries, licensed and regulated in Hong Kong, Singapore, India, as well as Dubai. In terms of our numbers, look, we're managing north of 1.2 billion in AUM with customers in over 20 countries, and also have empaneled around 130 plus active wealth managers across the globe. So you may go to the next slide. So what is Crystal? So I think for us, we really are a platform that's looking to democratize and fractionalize the private banking space. We're providing access to a product set that typically are available to the HNI and ultra HNI segment of clients. And through the use of technology, we're able to democratize and make it accessible to a much wider segment of clients. It's a product set that we offer, of course, are typically the institutional funds. We've got fixed income bonds, structured notes, many of the private market assets, whether they're single names or PE or VC funds. And of course, AVM is one of the products that we have on our platform, including many other alternative funds as well. So this slide just gives you a quick overview in terms of the products and services that we have. As I mentioned, we do have a range of products, but we also do offer a number of services in terms of the digital family office for many of our HNI clients, including some of the retail play as well through the Crystal Flex, which is more of the click and trade feature that we have on the platform. Okay, so that's just a brief overview of our platform. I think with no further ado, I guess we can jump in straight into the webinar. So I'd like to introduce Ashvin Murthy. So Ashvin Murthy is, he comes with 17 plus years of experience in financial markets, having worked at UBS and Natixis in fixed income and FX options divisions, respectively. Before, of course, launching the AVM Global Opportunity Fund in 2016. This fund is a macro investment strategy with an established track record and superior risk-adjusted return. And of course, we've got AVM's flagship fund on our platform, which a lot of you may be keen to learn more about. So Ashwin will cover that in the next few minutes and during his update. Okay, I think with that, I'd like to hand over to Ashwin to kick off his presentation and give us an overview of what's happening in the markets. Over to you, Ashwin.
Thanks, Ashvin. Glad to be back. I think it's been about 12 months since we last did this with Crystal. A lot has been happening over the last 12 months. And so I thought I'll start off with just a short introduction about what we do here at the firm. So we were established in 2016 as well, same as Crystal. Our strategy is a global macro strategy where we go long or short all four asset classes: fixed income, currencies, commodities, and equities. And the idea is it's an absolute return strategy where we try to make money throughout the cycle. So we're annualizing about 10% over the last 3 years. Where we differentiate ourselves is the risk management. Our volatility is 4.4%, so that's lower than a government bond portfolio. And we're uncorrelated to your stocks and bonds, right? So our idea is to provide diversification and a little bit of protection when things go south in markets. So we've been around for 6.5 years. We were recognized for a couple of awards, especially in 2021, where we were recognized not only for a 1-year track record, but it was a 5-year track record of risk-adjusted returns. So what's happened over the last 12 months since we last met? I think markets, we went through probably one of the most volatile periods we've had since COVID. We had a big drawdown in markets as interest rates went from 0 to 5% very quickly. And, lots of things changed in the markets, the way people thought about cash, the way they thought about value, the way they thought about growth. So what's happened over the last 12 months? So MSCI World Equities is down about 7.5%. Investment grade bonds were down 15%. And, your typical 60-40 portfolio is down about 8%. So there's really no place to hide last year and over the last 12 months. And probably the only place that actually made money for you was the US dollar. So during that period, the Howe Fund was up about 6%, lower than our 10% trend. But our volatility was 2.8%. So, it's something that we manage regardless of what sort of volatility regime we have in the market, high or low. We manage the volatility of our returns to. We want it to be below 8%. So the last 12 months has been even lower than that, is 2.8%. Right. So what helped us last year? We were long the US dollar and short S&P 500 as we were positioning for tighter financial conditions. So that helped the portfolio. What worked against us was positioning for inflation to peak earlier than it actually did. So we had some yield curve steepness, which lost money. And we were shorting Chinese equities in Q2, which stopped us out of some trades when China rebounded in June. Right. So broadly, that's what's happened over the last 12 months. And if you look at our performance, I guess over a longer time period, so this is the kind of risk return profile that you should be expecting. We kind of keep up with markets during the good times, as you can see here. And then we had COVID, that's where we went up. And then the next period is the last 12 months where the markets are down and we continue to go up. So we want to be there with the market during the good times and we're defensive and making money during the bad times. All right, now on to the outlook. So very interesting period. I think, just a month ago, everyone thought the Fed was going to 6% or 5.75%. Now everyone's worried about a banking crisis. I'm sure we'll have a lot of questions about that during the Q&A, so I'll leave it for then. But, I want to walk through something that's happening in the market right now. So over the last 6 months, people have been calling for recession, imminent recession. And I think a lot of that has been influenced by what happened with the war in Europe, the spike in energy prices, and the zero COVID policy in China. If you looked at nominal growth over the last year, it's actually been quite high, right? It went all the way up there, that it's been coming down, but it's still above 5%. In fact, I think it's at about 7%. So what we like to do here is actually look at what that annual rate is over the last 3 years since pre-COVID, right? I think that gives you a lot of information of what the average growth rate has been, because the COVID period has a lot of distortions, right? You had a period where it went down and it went up. So these year-on-year metrics that most people look at, not as relevant to us at the firm. We like to look at the annualized number over 3 years. So what is that telling us right now? Over 3 years, the annualized rate is still about 6.5% nominal growth. That's extremely high. Now, given all the tightening that's happened, why is that the case? So let's look at a few charts. First thing is, we know that households and corporates have very healthy balance sheets, and there's a lot of liquidity in the system. What does that mean? And the labor market is tight, so wages are going up. So that means people have spending power. So if you look at nominal retail sales, it's well above the pre-COVID trend, and there's got a lot of room to drop before it gets back to that trend. If you look at it on a real basis, it's still well above the trend. What does that tell us? I think the tightening will eventually bring this down towards the trend line, but it's going to take some time. because there's a lot of excess savings. Why do we think that balance sheets are safe and excess savings are healthy? Now let's look at this. This is the adjusted liquidity position in the market. What we look at is not only the Fed's balance sheet, we subtract the Treasury, the amount the US Treasury has, because there's no multiplying factor from the cash balance the Treasury has with the Fed. And we take out the total amount of reverse repo agreements with the banks or money market funds. That tells you the amount of liquidity in circulation. We are still well above this 2020 number. It has come down from this number. It jumped up recently due to liquidity being added to the system once the banking crisis unfolded. But if you look at this number, it's still very healthy, right? There's still room for this number to drop before liquidity starts to get tight overall. This is money supply. How much is floating in the market? Again, while the money supply growth over the last year is negative, look at how far it is above that line. That's the amount of excess liquidity in the system. This shows you most of the reports you read will show you this year-on-year growth rate being negative of M2 money supply and saying that that's going to lead to a big drawdown in equities or spending. But if you look at it over a 3-year period and annualize it, you still see it's extremely healthy, right? So I think the impact is because we had this big surge and it's coming off, it means that tightening takes a bit, the lagged effects of tightening will be a bit longer this time around. Now, this is an important chart. This looks at the money market assets and within money market funds currently. So post the GFC, when we had QE, money market funds exploded. And then as with rates at zero and opportunities abound, people started taking money out of money market funds and investing in the market. What did we get? 2011, we had the big commodity boom, the Arab rising, and that created a bear. Food prices went up, commodity prices went up, and inflation was very high. This time around, we had the same thing. We had QE go up. We had QE infinity for about a year and a half, and money market funds exploded. But this time around, you had commodity prices going up, food prices going up, and everything going up, but money market funds didn't come down in value. Why? Because the Fed continued with a lot of QE while that was happening. So now, with money market funds here, can you imagine what would happen if the Fed cut interest rates back to 1%? All this money is going to rush into commodities, real assets, equities, and we're going to get a big inflation problem again. So I think the Fed is acutely aware of that. So they won't be, in our opinion, they won't be cutting rates unless we have a credit issue in the market. This looks at household balance sheets right now. They're very healthy relative to pre-COVID levels. Corporate balance sheets deteriorated a bit and they have improved, still well above pre-COVID levels. This shows you financial conditions index in the US. While they tightened, they have eased over the last 6 months with longer-term yields dropping and credit spreads tightening. And this shows you wage growth. Again, instead of looking at it on a year-on-year basis, we look at it on a 3-year annualized basis. It's at a healthy number there, right? Almost above 4%. So these, that means the consumer is doing well in the US. That the household balance sheets are safe because they've all borrowed at 3% a year and a half ago. And so spending power is still there. Now, there's some early signs that the labor market is tightening. So there's something we look at where we look at temporary help services. So this is part-time employment. When that dips below the 12-month moving average, that usually leads the peak in the labor market, right? So we're probably thinking unemployment is going to start picking up over the next 3 to 6 months. This looks at, all that makes us believe, the whole reason we're looking at that is we think it's a bit premature for the Fed to cut rates. The markets have, due to the banking crisis, have priced in a lot of rate cuts. We do think they will react if there is another bank or there's another bank run and credit conditions worsen a lot. But if conditions stay the same, more likely than not, they'll probably stay on hold or hike one more time. But they're not going to be able to cut because inflation will come back very quickly. They need to reduce the amount of excess liquidity in the system. And they need to find a way to distribute it better. Because what they've done is they're reducing liquidity, the excess liquidity in the system. But there are certain pockets of the markets that we've seen that are getting impacted. Like some of these banks that are over-levered, the commercial real estate, probably some PE firms as well, where they're using levered loans. So there are certain pockets which don't have the liquidity, but the rest of the system has way too much liquidity. This looks at core CPI again over a three-year period. While that's going to come down, prices are still very high, right? So that's going to take some time to bring that down. Once these numbers come back down, I think the Fed's in a better position to try and cut interest rates. So just a quick look, if you look at inflation, energy inflation has come off. Food inflation is coming off. We're expecting that to go a bit lower. We'll show you some charts about why. Shelter inflation is also going to come off. This is a lagging indicator. Right now, rents in the US have stopped going up. The only thing that is really high, and this accounts for 56% of CPI, is this core services and shelter inflation. And that is directly linked to, I would say, a higher link to the labor market and how tight it is and wages. So it's important. That's why the Fed needs to maintain this tight policy, because they need to sort of cool down the labor market and bring down the amount of demand that's coming from the consumer. The consumer in the US accounts for 70% of the GDP. Now, this chart, this tells you why we think food prices coming down, because the actual food commodity prices have come down. So we're expecting inflation to come down with it by the end of this year. Again, this is a rental CPI simulation. We're expecting that to come down. And this shows you that the governments have been trying. Fiscal impulse has gone into negative, spending has gone down. So what has that done? So while the consumer is healthy and spending is quite good, business sentiment has started to sour. So if you look at manufacturing PMI, that's come down, it's gone below 50 now. If you look at the new orders, which sort of leads the economy, because that's what businesses are doing, they're spending, they're seeing new orders and they're going to invest in their businesses. That went down quite a bit. So and that's sort of, that lags what prices are doing in the market. Now that prices have topped out and they've gone down, we're expecting new orders to bottom out sometime at the end of this year, which would probably be in line with where we think stock market bottoms as well. As we get to the end of this year, I think growth will probably have slowed down based on our leading indicators that we're using. And inflation will be much lower. And that should give the Fed some room to start reducing interest rates because inflation is now more controlled. This shows you where S&P valuations are now. So relative to real yields, they're extremely high, right? If you looked at where real yields are right now, you would expect valuations to be closer to 14 multiple or 13 multiple. But right now they're trading closer to 16 and a half. Why is that the case? Again, we're going back to that liquidity framework that we saw. The amount of money that's floating around the system is raising all asset prices. So let's move away from the US to Japan. I'm just going to touch on Japan and China a little bit, given some things we're looking at in the portfolio right now. Japan obviously has seen inflation shoot up over the last 12 months. We got the highest print in 41 years. The last month, we saw a big drop in energy inflation because they've started to provide subsidies. But if you look at core inflation, it's still ticking higher, something we've seen in the rest of the world. So we think with what's happened with the banking crisis, Japanese yields have, they were hugging the upper band of the YCC limit that the Bank of Japan has implemented. Right now, it's almost quite a fair bit lower than that upper band. So there is room for Japan to now remove that yield curve control without affecting the markets. And that's what we're expecting to happen sometime in the next 3 months, right? So this inflation number, it seems like for the first time, many companies are actually raising wages in Japan. So, we should see that lead into higher prices in the retail sector as well, because they can't afford it, right? This is just a long-term chart. If you look at Japan CPI, it was hugging zero for the longest time and is now started to break out. And these are interest rates in Japan as well, zero for the longest time. So, there is room for this to move up a little bit. We're not expecting you to do what the US did, but I think as a first step, it's important for them to get rid of this yield curve control because it has distorted the bond market. At one point, they owned more than 100% of the JGBs outstanding, and that was creating problems in the market. So looking at China, obviously, 2021, they're the first in, first out of COVID. In 2020, they started booming, and then, I think the Chinese government tightened policy first by raising rates well before everyone did. And then they introduced a lot of regulations to tighten up the tech sector and the real estate sector. So these green numbers here show you that economic activity was good. Eventually went to very red last year when all the regulations were hurting the tech sector and the real estate sector. The real estate sector caused a lot of credit issues as well. So we saw consumption go down, and then finally zero COVID affected the market as well. All this is starting to reverse now. So we're going to start seeing some green shoots. So the first 2 months data has improved. We're expecting March to improve even further. So things are looking good on that front. So we'd expect domestic activity to pick up significantly over the next quarter. But we're also expecting that to be offset somewhat by slowing demand globally for exports, right? So at least at this point in time where China needs domestic activity to pick up the slack from slowing exports. And that's something we should be seeing over the next couple of quarters. The real estate market, while it's, the credit situation is much better, we're not expecting it to accelerate and pick up the slack this time around. So if you look at GDP growth, it went down and now we're expecting it to trend higher. You can see all of this popping up. Just, I think when we talked about it a year ago, everything looked really bad and things are starting to look a bit better. So business sentiment is picking up above 50, consumer confidence all the way down. There's room for this to go up quite a fair bit. Retail sales is heading higher. Money supply growth has room to grow a bit more. But if you look at M2, it's really high, right? So there's money in the system. They can spend it. And the latest numbers we've seen from the margin account balances in China show that retail investors have started to get involved in the local Chinese market again. So, you could see a rebound in markets pick up over the next few months. So just to sum things up, I think for the US, we're moving from this period of stagflation where inflation was high, growth was low, and we're moving towards this disinflationary recession, in our opinion, or a slowdown, right? So inflation is going to slowly come down. Nominal growth is going to go down as well as the lagged effects of tightening take place. So the central bank we think they're probably done, or maybe just one more hike coming up in the next month, depending, because we're expecting the next inflation print to be quite high. For some technical reasons, I think the goods prices are going to rebound with used car prices going up. So that could, if markets are quite stable, if we haven't had another bank run, there's a chance we get another hike. But we think we're done there, right? I think as long as they have not implemented something to solve this banking issue over the long term, there's always going to be a risk that another bank run is going to happen. For now, they've saved, all they can do is save a bank when a bank run happens, but they haven't done anything to prevent it from happening. So in Japan, with multi-decade high inflation, we're expecting the Bank of Japan to finally reverse its yield curve control. That should see the yield curve steepen out to the 10-year mark. So that's what we're positioned for. And in China, where we're constructive, we think, domestic activity should pick up while it can slow down a fair bit in the rest of the world. Okay, with that, let me hand it back to Ashvin so we can open it up for Q&A.
Great, no, thanks, Ashwin. Those graphs were quite insightful. So let's open it up for Q&A. So I think we can track some of the questions that are coming through. Look, the first one, Ashwin, I guess you can see this too, but what are the global economic outlooks for gold and silver, just given the macro currently?
Yeah, it's interesting you asked that. So actually at the fund level, we only trade 3 commodities. We trade gold, we trade copper, we trade oil. Why do we trade these 3? Because they have a direct link to the macroeconomic indicators that we follow. Silver is more a demand supply, has a bigger demand supply issue. It's more a niche market. So I'm going to leave silver out of it. I think when it comes to gold, I think gold tends to do well when the Fed eventually starts cutting, right? So I think the reason we saw that big spike was perhaps a little less confidence in the US dollar after the banking issue and interest rates being cuts being priced in. So I think we've had that big move in gold. I don't expect it to, I think we've probably seen the high for the time being. But if we do have a bank run and the Fed does cut, I think that's going to send it a lot higher. We're expecting gold to have topped out here, and the next move is probably going to happen in Q4 this year.
Got it. I guess we'll just wait for a few more questions to come through. But I do have a question, Ashwin. I guess this is more in terms of broadly the hedge fund industry, specifically macros. So we have recently seen a bit of a reversal of fortune from 2022 with some of the steep losses that some of the macro funds have had, given the recent bank failure. So I just want to have your take on this, and what's your view on macro hedge funds in terms of this year, and is performance likely to be muted? And I guess specifically in terms of AVM and the fund, how are you positioned for that?
Difficult question, but I'd say, okay, for us personally, I think at the firm, our correlation to the macro index is quite low. So, I think our correlation to our peers is only about 15%. I think your typical macro fund would probably trade momentum and bets on certain events, and there's a lot of clustering of P&L, right? So the way we trade markets, we want steady returns throughout the cycle. So we treat egging out those returns every month. So if you look at our correlation, it's quite low. So like, we're doing okay this month. So we weren't too impacted by what happened because I guess we weren't chasing the themes that everyone's chasing. But what I've noticed in the macro landscape right now is, some funds are really big, and some outsized moves or stop losses from certain funds can really have a big impact in the markets. And I think it's extremely important to understand the liquidity of the instruments you trade in. It might be easy to trade markets when they're calm, but when things get chaotic, the ability to exit positions is very difficult. And I think probably a lot of macro funds are not looking at that exit risk carefully enough. We had those unwinds in 2021 as well, big unwinds in the macro funds. And a similar one just happened. So I think that's something that's not going to go away as long as people do not pay attention to the exit risk of some of these trades. You're probably going to see these kind of things happen more often.
Right. And in terms of risk allocation, you said you're fairly evenly split, between equities, fixed income, and FX.
Right now, we don't have a fixed allocation between the asset classes. What we want to do is think about it from a thematic basis and invest in the asset class which gives us the best risk reward profile, right? So currently it's split between fixed income, equities, and FX. But that could change. Last year there was a bit more FX in the portfolio, for example. The year before was predominantly rates. So it really depends where the risk reward is. Just give you an example. At the start of 2021, when we came into the markets, we were expecting inflation to hit 7%. And so we put it out in a newsletter at the end of the year. And there were a few ways to play that. If you think growth and inflation are going to pick up, you can be either long equities, you can be long commodities, or you could position higher interest rates. So when we looked at the markets, equities had already rallied, commodities had already rallied, and bond yields were still very low because everyone believed the Fed was going to be on hold till 2024. So that was an opportunity set for us. So when we chose rates because the risk reward was the best. That's how we look at markets.
Understood. Okay. Great. So I think we've got a few more questions. So one of the questions we have is, given this outlook, do you expect growth sectors, tech related, to come back into favor and value to struggle now? And we've seen that a bit in March. And what's your sort of 2-3 year view? Again, specifically Europe versus US, if you have any inputs.
Sure. I think, we're not equity specialists as growth versus tech. I know a lot of these moves are related to interest rates and very quant driven. A lot of quant funds use interest rates to decide whether they invest in growth or tech. I think one thing to remember is these tech companies are not immune from a profit recession or a slowing in growth. So I think if you look at the if you look at the market cap of the 8 biggest tech companies as part of the S&P 500, it keeps growing. So we just have to keep it in mind that that's the last place that everyone's hiding. When the economy eventually turns and these guys start issuing profit warnings, they could sell off as well. So I don't buy the argument that rates are lower, so you're going to invest in tech, because you should really look at their earnings projection and what's going to happen over the next 3 to 12 months. That'll give you a better idea of whether you want to invest in those. It's a very crowded area. The minute you start getting we've seen that in 2001, where the first time it had a rebound, everyone went back to the bellwether tech companies, which eventually dropped a lot because profits declined. So this period is really a profits recession. So I think we have to keep that in mind.
Got it. Question, I guess, specifically in terms of equities. And always the question is, when are the Fed likely to cut rates? And obviously there's a view that happens second half this year or next year. But would you suggest any particular, allocation from an equity sector perspective?
We like China. I think there is room for that to improve. It's unloved. I think a lot of foreign investors have exited the market. So we're focused on the domestic side, where the government has specifically said they want to increase participation by retail in the stock market, move away from the property market and invest in the stock market. And I think with all this fiscal stimulus, targeted fiscal stimulus in the system, we're expecting it should outperform. I think if we had one pick in the globally, that would be where we would.
Got it. Another question, I guess, more referencing back to the early 80s on the disinflation theory. Would you expect a similar outcome post the initial recession?
So it depends what inflation is doing at that point in time and how long the Fed has decided to keep rates on hold. Because we do need that nominal growth number and the wage growth numbers to come down in order to get inflation to remain low. Otherwise, it's going to go down and go back up, which is what happened in the 80s, actually. So I think I do believe that the bull market will come back. I do think if inflation gets back to 2%, we do have room for this to start going up again. But I think that's more a story for 2024. I'm not expecting a bull market like we had in the last 10 years, however, because that was driven by a lot of liquidity. And I think the central banks globally have learned that they pumped in way too much liquidity and they are struggling to rein that in right now.
Right. All right. So I think a few more questions coming in. I think obviously different themes here. I think we can stick to the inflation theme. I think you answered this over here. So I guess the question specifically is around why would inflation kick in if funds move out of money market funds into other asset classes? But why do you take that?
Yeah, because they're going to drive up the prices of commodities, and I think that will eventually, consumption will pick up, commodity prices will go up, a little bit like what happened in 2021. So when money starts pouring into all of these assets, it's going to drive prices up, and financial conditions will ease. So you should see inflation pick up pretty quickly if they do it. If they start cutting rates sometime in the next 3 to 4 months.
Right. And in terms of credit spreads, what's your view over there? Do you expect this, to obviously get worse and widen, or do you think they're fairly okay at current levels?
No, I think the trajectory is to widen. I think the Fed, as long as the Fed stays on hold and doesn't stimulate the economy, the slowdown will lead to more credit issues in certain sectors. So it's just normal. It's part of the cycle. We should see spreads go back to where they were. By the end of the year, I would imagine spreads will revisit the highs they had in Q3 of last year. I think last year was more a liquidation issue. It was more a reval of instruments because they were all priced on zero interest rates. This year is the real slowdown and balance sheet issue that potentially can happen in certain sectors of the market.
Right.
I think the single B loans are the most vulnerable part of the market right now because that's where a lot of risk sits. And a lot of these companies are highly levered, but not too much. And the free cash flow is not very healthy.
Mm-hmm. Mm-hmm. Okay. And, obviously just given this banking crisis that we've been seeing in March, do you think that this will be fairly isolated? Or do you think there's something that's sort of brewing under the hood that could sort of blow up in the months to come?
There is a potential for this to blow up, I think, because these banks are not that small. 250 billion is bigger than the third biggest bank in Germany, if I'm not wrong. So I think the US definition of a small bank it may not be the right one. I think what we're worried about, and it feels like you're short some downside risk here, is the longer they let this be, the more you have deposits flowing out, from all these regional banks. Because we were there, there's no downside to taking your money out of some of these smaller banks and putting it in JP Morgan and Bank of America. Yep. So as long as those flows continue, it's going to create issues. So we were expecting them to come out with some regulation a bit quicker to prevent this from getting worse, but it seems like politically it's getting a bit tough. There was some news yesterday that the FDIC is going to review its regulations, but that's only on the 1st of May. So after that day, as long as it's a confidence issue. We saw that with CS as well. I guess their tier 1 ratios were okay, maybe not accurate, but the main problem was they were losing 10 billion a day. So S&P gives them 50 billion and they lose 10 billion a day. It just, if people start taking money out, it doesn't matter how well you run your business.
Yeah, no, that's what we've seen recently. Specifically in Europe, and obviously what's happened. What's your view on that region, both from an equity and FX perspective on the currency?
I think Europe, on the banking side, it looks like regulations are a bit better. They do sensible stress tests on their markets. I guess they went through the whole Eurozone crisis, so banking regulations a bit better. Well, the US started easing banking regulations in 2018. So on that front, it does look better, but obviously, again, crisis of confidence is an issue, as we saw in Deutsche Bank last week. So I think on that perspective, I think for us, we think the euro is hitting peak inflation as well. I think their growth issues are going to resurface. we believe the US growth will outperform European growth in the medium term. So we're expecting the euro to top out and then hit lower as the global recession starts to pick up.
Okay, thanks for that. We have a question from Rajneesh over here. And so his question specifically is around, markets front run the real economy by 6 to 9 months. So with your view of a bottoming of the ISM new orders by the end of year, do the markets embark on a bullish run, given that recession is to follow?
And that's obvious. So, for us, we're bearish now. So the way we think about markets is the next 3 to 12 months. And the next point we're looking at is when the Fed is going to cut to support growth.
Mm-hmm.
I think if you're looking at some of the charts we looked at, I think it's tough for the Fed to react as quickly as it did the previous few cycles. Usually when growth is slowing, we don't have an inflation problem. The last time we had that was quite a while. This time growth is going to be slowing while inflation could be sticky. If inflation is low enough, the Fed will cut and that should mark the bottom of markets.
Okay. Just a couple of more questions, and I think we're okay on time here, so I'll just pick these up. This is, I guess, specific more for the private markets and maybe not relevant to the strategy you run, but the question over here is over the last 5 years, they've delivered substantial alpha, right, on the private side versus the listed assets or listed equities. What is the, sorry, I think I just, yeah. So what's your view in terms of, do the PE funds struggle in relatively high interest rate environment or regime? Do you see that happening going forward? Yeah.
It's definitely not going to be as easy because a lot of these PE investments do well due to the embedded leverage in these investments. When you do a buyout and you finance 80% of it at 0 interest rates, the deal looks better. When interest rates are 5%, these deals become a lot tougher, especially with credit spreads widening. So I would imagine the expected returns using the same methodology of investing would be lower. If they start getting more careful and looking for better deals and looking for higher hurdle rates on the kind of acquisitions they're looking at because of the high interest rate, that could be okay. But I think, looking at the amount of AUM that's been raised in that industry, I would imagine the current vintages may not provide as good returns as the earlier vintages.
And so do you think that, at least within the PE space at current levels, do you think there's going to be a lot more pain and perhaps staying on dry powder is more prudent, or do you think these are good levels to sort of start entering back in?
Depends what sector, I suppose. I think we've seen a lot of write-downs. Some funds have, some haven't. But obviously, if your investments are generated through a lot of leverage and low interest rates, you would expect some write-down in the funds when leverage becomes more expensive. I think the tech funds have written down their investments. I wouldn't mention any names, but they've gone down 20-30% in the last year, right? But you'll have to look at other pockets which were invested in commercial real estate, etc. Many of these loans maturity walls are coming up in 2024, 2025, 2026. If the Fed doesn't cut rates by then, and they need to refinance a 5% loan at 10%, it may be difficult.
Right. No, that makes sense. Well, just on that leverage question, I guess specifically more for the fund, and one of the questions we have from Maxwell over here is specifically, in terms of positioning size, how much leverage do you use? I don't know whether you can share, but to what extent, please do. And are the trades directional or relative value in nature? If you could just sort of pick that up.
Yeah, I'll start with the second question. So we do both directional and relative value, but we only look at relative value when the level of the VIX is below 25. Right, 20 to 25. That's the barrier. The reason we do that is many relative value trades are actually, you use quite a bit of leverage, and it's actually short volatility. When volatility spikes, a lot of these relative value trades explode. Some of the pain we saw in the global macro space this month is because a lot of people had paid US positions versus receiving in Korea and some other positions. Right, these are highly levered trades where the exit is not that easy. So the volatility picks up, it becomes very difficult. Since COVID, we have not seen an environment where that's been really healthy. We prefer not to have these kind of short volatility elements within the book. So it's been predominantly directional. And your first question was about leverage. So we run a pretty low volatility strategy. We're quite nimble. We trade around our positions quite actively. So we don't have to hold. To generate X amount of returns, we probably hold about 1/3 the average size that our peers hold in order to generate these returns because we trade actively around it. So our margin, because we use futures, options, and FX forwards, etc., most of these are traded on margin. Our margin to equity is usually less than 20%. So there's 80% unencumbered cash.
Okay. Okay, no, that's good to hear. And I guess another question specifically on the fund is on the max historical drawdown.
Yeah.
I guess specifically what was the driver for that? And also the outlook in terms of how much do you expect to grow the size of the fund itself?
In terms of the drawdown, it was we got stopped out on a couple of trades. We have a very strict risk management framework. When we get into a trade, we always start by asking ourselves how much we're willing to lose on a trade if we get it wrong, right? Rather than thinking of how much money we're going to make. So if we allocate X amount as a stop loss in the trade, we know exactly where those stop loss levels were. Mm-hmm. And we saw a couple of volatility events in 2018, which unfortunately affected the fund. These were good trades, but due to the volatility in the underlying, they hit our stop losses and then went back up. So in that, one thing we've done differently since that period in 2018 is we started using options for our stop losses when they're cheap enough. So that avoids you from getting stopped out on good trades when someone needs to exit and moves the markets way more than they should. So an example with this move in interest rates over the last 2 weeks, it's not really macro. It's people needing to exit positions, and that's why you have these wild moves, right? Yeah. Sorry, the next part was what do you expect? Capacity of the fund, I think we've always traded this like $1 billion fund. We can size up our trades 5 times now with no problem. We could do that in less than half an hour. So I don't think no issue with capacity at all.
Right. And obviously, just given the bank runs, what's happened over here, one of the questions that we also get asked a lot is in terms of who our custodian is and how do we ensure asset security. Would you be able to share a little bit more light on that in terms of AVM funds? I believe you have JP Morgan as a prime broker, right?
That's right. And we put most of our spare liquidity in T-bills, and that's in a segregated fixed income account. So very strict about cash management here.
Good to hear. Okay, we have 2 more questions here, so I'll pick that up. So one question from Rajneesh is, so you mentioned around global recession, your view on the severity of such an event, how does it leave the likes of China, India, and more broadly Asia unscathed?
Yeah, so I think in terms of the global recession, it depends at what pace it happens, and it depends how the central banks react. So, if we're having a recession and inflation is very low, the central banks are going to come out and support the markets, right? China is currently always in a different cycle compared to the rest of the world, right? So, they're picking up now when everyone is slowing. Last 2021, they were slowing down when everyone was roaring. So, we've been used to that. Over 10 years, they're just counter-cyclical versus the rest of the DM world. I think domestic activity in China will not be as correlated to the rest of the world, but their exports are highly correlated to US retail sales. So we see those retail sales go down, the exporters in China will get affected, but their domestic activity might chug on well, right? We might be doing okay. I think India, again, also another one, which if you look at the correlation of their economy to the rest of the world, is not as high as some of the other developed markets, right?
Yeah, I agree with you on that. All right, I think we'll probably take 2 more questions and we can probably stop the webinar session at that. So one of the questions we have here is, again, specifically for Japan. So with the new governor for BAG, do you expect changes to YCC? Do you think a long yen position is suitable to express a bearish view to global economy?
Yeah, I think we are expecting changes to the YCC. It's where, I think it would make sense to abandon it or widen. They could widen the range, but maybe it doesn't serve that purpose. The reason why I think abandoning it makes a bit more sense is because they can allow a little bit more volatility in the bond market, which has just not been working for the longest period of time, right? They need to get back some natural volatility. The BOJ needs to be less involved in this market. They just own too much of the bonds, right? They need the private market, private investors to get involved. So I think that's why we prefer to play it via shorting JGBs at the moment. Because people have been washed out of their positions over the last 2 weeks in particular, the yields look rather attractive. Your downside is not, when something's trading at 20 basis points, the downside is quite little, but yields could go up a fair bit. I think the yen makes sense on a cross asset basis. So if they do exit the YCC, you should see repatriation of yen as investors. Japan is the biggest international investor out there. And when yields in Japan go up, there's less incentive for them to invest in high yield bonds in the US or Europe because the hedging cost is really high. They'll just repatriate that cash and invest in JGBs. And they'll, basically the demand that's coming from the BOJ, now that's going to shift towards the private investors. So with that repatriation of cash, we do like being long the yen versus its trading partners, not versus the US dollar, but versus the trading partners. As you get over the next 6 to 9 months, we like the US dollar at the current moment, and having the yen in your portfolio will be important as well.
Right. Another question we have here, I guess, is comparing the European equity market to the US equities, and in terms of valuation, do you think that they're cheaper than the US counterparts currently, and whether one should be looking at equity space for Europe?
Unfortunately, I think I'm not the equity expert, but I like to say that might be the value trap that everyone talks about. These things look good based on the last 12-month earnings, but generally these guys see their earnings drop significantly when there's a recession. If you go back and look at historically. So, I don't think it probably makes sense to look at it from a valuation perspective right now, unless you think we're in a recovery and everything's going to get better. If you think things are going to get worse, you'll have to revisit what your assumptions are of earnings in this value sector.
Right. Okay. I know you've answered a lot of questions, Ashwin, so I think we'll just wrap it up with this last one here. And I think very pertinent just given the context. So I think the question is really specifically around risk management, around the strategy. So if you could just shed a little bit more light for our audience on what is the sort of risk management tools that you're using, that would be great.
Yeah, so there's, I guess we've quite a lot of constraints within the fund. So risk management is one of the key things we do, we pay a lot of attention to. The first thing is, again, our philosophy, when you get into a trade, how much are you willing to lose if you get it wrong? So, it's a highly data-driven strategy. So we try to investing is about increasing your batting average. If you can accept, say, even if you win 7 out of 10 times, if you can accept that 3 out of 10 trades you're going to lose, it's about how you manage those 3 trades that makes the big difference, right? Because you want to avoid big drawdowns. So by putting fixed stop losses on those 3 trades in case if they go wrong, we're able to take those losses and move on and focus on the other 7 trades which are making money. That's the first thing, right? The philosophy. The second bit is how we manage our trades. We trade around our core positions. We don't just say, I'm going to buy the S&P 500 and leave it. What we do is when we start a position, we're willing to add to that position when it goes against us, and we'll trim that position when it goes in our favor, right? So say we buy it at 4,000, we'll add at 3,900, we'll add at 3,800, and at 3,700, we'll stop out. So we know exactly what size we're going to start with, so that we're able to add, and stop out and not lose more than our stop loss amount, right? So position sizing is backed out by how much we're willing to lose. And then when it works in our favor, we'll trim, and we'll keep a core position. So effectively what you're doing every day is buying low and selling high systematically, right? And that's important because that increases the odds of winning and brings down your volatility a lot. And we do this, the reason we do it systematically is because we're all human. There's a cognitive bias. So what happens when something goes down? In general, you wish you never bought it and you're hoping it comes back to break even. Yeah. And when something goes up, you wish you had bought double. You don't want to take profit, right? Yeah. So this goes counterintuitive to what our natural instinct is, and it allows you to save money and reduce your volatility. And then as an overlay, we have a stress test to look at. Because the way we construct our portfolio is based on economic regimes, we need to find out what happens if we're wrong. What happens if we enter a different regime? And we stress test our portfolio, we buy tail risk hedges. The reason why we do that is because you can't just look at what's happened over the last 12 months and decide that looking at the correlation of volatilities of your assets in your multi-asset portfolio, this is how much risk you're earning, it should be fine. What we want to make sure is that our risk management framework is robust to regime shift. When you go from a bull market to a bear market, or a low interest rate environment to a high interest rate environment, or a low vol environment to a high vol environment, correlations of volatilities change a lot. So you need to understand what happens to your portfolio, and you need to have a tail risk hedge against it. So that overlay, make sure that we're kind of comfortable with. It allows us to sleep at night.
Right. And in terms of just touching the portfolio and looking at it closely, is that something you do that on a daily basis, or do you have rules around that in terms of trigger levels that would make you sort of step into kind of tweak things, or how do you sort of manage that?
Yeah, it's real time. We have our 5 assumptions why we like a trade. Every day we're going to come in and look at the data. Does it corroborate why we still like that trade? If things change, we're going to get out of the trade. We don't have to wait to get stopped out. And the systematic way of trading around the core positions, we've built a model that actually tells us what levels we're going to add and trim. So we just come in the morning, place our orders. We don't override it. They're there for a reason to make sure that it protects us, and then we continue trading. I think, just making sure you only buy on dips and sell on rallies is very powerful.
Yeah, no, that's good. And I think that's heartening to hear, and thanks for sharing that information. So, we don't have any more questions from the audience. So I think we're good on that front. Is there anything, Ashvin, that you would like to share? Perhaps, I think you've covered a lot during this webinar. If there's any sort of closing remarks that you'd like to kind of share with the audience, love to hear that from you.
Yeah, I think it's one of these trading environments we haven't seen for a long time because inflation's at where it is. I think, the central banks are not going to be as trigger happy as they used to be. The number one question we get from investors is it time to buy the dip? Is the Fed going to cut rates? And I think we just have to go back to the 2001 playbook to see how long that bear market was. We suspect we're still bearish on the S&P 500. We suspect this bear market is going to be at least as long as what we experienced in 2000 because inflation is so high and the central banks can't come into the markets and support the markets yet, unless there's a credit event. But if there is a credit event, we're probably talking about a 2 handle on the S&P 500, not 3.
Okay. So I guess I'm going to put you on the spot. Where do you think S&P is going to finish for the year, the end of year?
I think we revisit the lows before the end of the year, but it depends on whether the Fed comes in and what they're going to do to support markets.
Right. Okay. Look, I think we're just well on time, good on time. So I think we're good to sort of conclude the webinar today. So Ashvin, thanks so much for your time. Appreciate you sharing those slides and your insights on the market. And again, thank you for all of you that sort of dialed into this session. If you have any questions, of course, you can always reach out to us. More information on the AVM Global Opportunity Fund is, of course, available on the Crystal platform. So if you don't have an account, do sign up and get your KYC done. It should not take you more than 10 minutes, and you can get access to all the information there. But of course, if you are already clients of Crystal, do refer to the portal for the latest fact sheets and newsletters on the fund. And of course, if you have any follow-up questions, do drop us a note, and we're happy to sort of get back to you. But once again, thanks everyone for your time. And Ashvin, thanks for your time. See you.
See you. Thank you.